Hi there, good people. Welcome to Fin Talk with Em. Today, let's talk money. There are many ways to make money in the stock market. All those clickbait strategies that could possibly make you a millionaire in 10 days. If you're told they're true, you will have figured by now that they require you to have millions in your pockets or under your mattress, but are really to begin with. You get the gist of it. We are going nowhere near that today. On this channel, we like to keep things simple like we always do. So, what have I got for you today? One surefire way to grow your wealth. Stay tuned. You will have guessed by the title that today I'll be making a case for why investing in index fund is a surefire way to grow your wealth. But first, some preface. There are multiple ways to play the stock market game. You could either go stock picking or you could go down the investment funds route. Starting with stock picking. Stock picking or stock trading is buying and selling of individual stocks on a stock exchange. Now, if you're not a seasoned player, stock picking can seem like betting on the next World Cup winner of any sport. You've done your homework, you've done your due diligence, you have a thesis, yet you may or may not win the bet. Wins and losses are huge in stock trading. It's a game of high risk, high reward. Individual stocks, as you may know, are subject to violent swings. Unless you are a high frequency trader or a nerdy quant beating the living daylight out of computers, it's no easy feat to win against the algorithm war consistently. That's because millions of dollars are spent on AI-based trading every year. And if you've heard of arbitrage trading, that thing is for real. For those who don't know what arbitrage trading is, that's where big trading companies adopt a strategy to buy and sell stocks in different markets to exploit the price difference. For instance, a trader can buy in a European stock market and immediately sell in New York Stock Exchange and make a 10-cent profit per share. 10-cent profit, you heard me right. What can 10 cents buy you and I? Pretty much nothing. But these big companies play on big bucks. So small profits on big volume at ultra high frequency trading can lead to big bucks. It's a game of milliseconds or microseconds or nanoseconds, call it whatever you like. Or you could rely on the next meme stock and hope that it could come to your rescue to make you the next millionaire. But we all know how that could end for most traders. Or you could go down the traditional route of buying and holding the high conviction growth and value stocks for a long period. This can be profitable, but then that also requires you to be on top of the game. If you're just basing your decision on tweets, forget it, you're already too late. That being said, if you are a risk taker, then go Tiger, I'm rooting for you. But if you're not, then listen on. So, moving on, investment funds. What are investment funds? Unlike individual stock picking, investment funds are collective investments that give you exposure to a range of stock or other assets. There are active funds and then there are passive funds. Active funds are managed by professionals called fund managers who are responsible for constructing portfolios based on the fund objective. They, along with analysts and a research team, conduct their own independent research, do fundamental and technical analysis, and actively monitor the market. The goal here is to beat the market and outperform the benchmark indices or sectors. While this is much safer than stock picking, there is still no guarantee that funds will perform consistently in the long run. Besides, the biggest downer is the cost of active investing. Active funds charge high fees, also known as expense ratio, for managing the fund, which often range between 1 to 2% and sometimes more. That said, if you are an investor looking for something niche or bespoke and are willing to take risks, then active funds can make you rich in the short run. But for the rest of my risk-aware counterparts out there who want to sleep better at night and don't fancy any more excitement than that's already brought by the domestic grind, then investing in index funds makes sense. No, it won't make you the next Musk or the Buffett of the world. And it can lack adrenaline that the stock picking or active funds may provide. But it's proven to make you wealthier than you are now. That's because if you're saving and investing, you're already winning, my friend. So what are index funds? First, some learning. These are passive funds, also known as tracker funds, that only track a specific index like for like. These funds are constructed to track the components of a financial market index. They replicate the movement of the index they are tracking. For example, the most popular US index, S&P 500, is a basket of 500 large companies listed on the stock exchanges in the United States. Similarly, there is FTSE 100, which is an index of UK's 100 largest companies based on the market value. Then there is Nifty 50, BSE Sensex. These are popular Indian indices. Depending on which country you reside in, your local stock markets will have many such indices that track companies within the country, either based on their size, such as large cap, mid cap, or small cap, or those that follow a specific industry or sector, such as your infras, healthcare, metals, etc., which are also called thematic or sectoral indices, or those that track basket of currencies or commodities. Some countries have international equity indices that track stocks of markets worldwide. For instance, in the UK, we have FTSE All World Index that tracks stocks of developed and emerging markets. In the US, you have S&P 100 Global that tracks performance of 100 global companies. Index funds can be conventional index funds or ETF index funds. The only difference between an index fund and an ETF index fund is that the ETFs are bought and sold on a stock exchange throughout the day, just like stocks, whereas index funds can be bought and sold only at the end of the trading day at a set price, like an active fund. So then, coming to the burning question, why do I think index funds are better than stock picking or active funds for an average Joe or Jane? Let's start with cost. Index funds are passive in nature, i.e., there is no one actively managing these funds, and therefore they are low in cost. Some as low as 0.03% compared to 1 to 2% for active funds. And because of the low cost, they tend to outperform most active funds in the long term. You know the acorn analogy. The tiniest acorn can grow into the largest oak tree. So small differences in cost can lead to significant difference in returns over the long period. And for the low cost, there is absolutely no compromise. On the contrary, index funds provide access to the best stocks and assets you can think of, as they closely follow the profile of a particular index. Furthermore, they are touted as the diversification kings, as they mirror the same holdings as of the index they track. And therefore, they're simple and transparent, taking all the guesswork out of them. It's not your get-rich-quick scheme, and to many it may seem like dead-and-out way of investing. But if you're looking for slow, consistent growth over the long term with predictable returns, then index funds can offer you just that. Achieving consistent growth via any other form of investment has historically proven more difficult. That is because index funds only seek to match the overall risk and return of the market rather than attempting to beat the market. In the case of individual stocks and active funds, they can both outperform and underperform, but the overall market only goes up in value over time. This is because the constituents of a benchmark are constantly revised. For instance, the only best 500 companies in the United States make it to the S&P 500 constituents list. If at any given point a company underperforms or doesn't meet the index criteria, it will be replaced by the next best performing company. As long as you're invested in an index fund that tracks the S&P 500 benchmark, for instance, you stand to benefit from the revision without having to do any hard work. And true to this theory, index funds historically have always had an edge over their actively managed counterparts in the long run. Most index funds are believed to offer 10% average annual growth if held for a long period whilst outpacing inflation. At this rate of return, it is proven mathematically that you can double your capital every 7 years. The power of compounding is startling. The longer you hold, the more your money can grow. So if you are a beginner or a novice, or even a sensible investor with an exciting life outside of the stock market, as some may want to describe it, then investing in an index fund is exactly what you need. It's just set it and forget it investment strategy. Now, if you're convinced, here are some tips on how to choose the best index fund. While a lot depends on your personal investment goals and risk tolerance, here are a few tips. First is to identify the index you want to track, i.e., which category or sector you want to invest in. Next is to look for funds with lowest expense ratio in that category. You want to keep the cost low. Third, rather than trying to time the market, stay in the market by investing small at regular intervals to distribute the risk by keeping your average low and to benefit from compounding. And many countries allow index funds to be held in tax-free investment accounts such as your 401k or Roth IRA if you're in the US, or ISA if you're in the UK. Try to maximize the allowance. You obviously have an early mover advantage if you start young, but it's never too late. There are just a few things an investor can control, and choosing to invest is one of them. So start today and thank me later. And I have an important task for you today. If you do like my videos, please do consider subscribing and liking. I hope to see you in the next video. Take care until then.